up, everyone? This is Phil from Market Rush Trading. Happy Friday. As some of you guys may know, whoever who's watching this and who is in our Discord community, you guys know that we don't usually trade on Friday. That's a way of us personally, uh, practicing risk management. You go throughout the week. Let's say you have a good week from Monday through Thursday, great returns, right? Usually, we like to just take a break and enjoy the weekend and not necessarily risk, putting back our profits within the market just to lose it. Imagine going into the weekend, um, and it's Friday and you're up, let's say $5,000 from Monday up until Thursday, you're up 5,000 and you're feeling really good about yourself, really confident. And on Friday, you go and put it right back into the market. Now imagine losing that. Of course, none of us would want that. It's just a personal thing that we do and it works. We do not trade on Fridays unless there's, great opportunities within the market or a great setup for a possible swing trade into the next week. But if none of those things are available, we usually stay away from the market. And today's a good Friday to go into risk management, of course, which is what this video segment will be about. There's a lot of ways of practicing risk management, in terms of diversification, money allocation, and simply just taking a break or a few days away from the market itself. There's different ways of doing it. We will dive into a few today that we feel like you guys can use, throughout your trading journey, especially for new beginners who do not have a lot of money in their accounts or a lot of money to start with. We will be going a few things that you guys could definitely use that specifically caters to those with small accounts. All right, so let's get started. All right, so risk management, as you guys may know, a little, risk management, a little bit of it, a lot of it can go a long way. No matter the account size, it is very important to practice it. It prevents you from blowing your account on risky trades, right? Let's say you have $1,000 account or even a 5,000, even a 10,000 account. If you do not practice risk management, that account is at risk of being blown from, possibly 10,000 all the way to 500 to zero. That happens a lot. Risk management help you discipline yourself for continuous growth. This this is a process. It's not a get rich overnight type of game. It's a marathon. It can happen, right? You may enter a trade and it may make you thousands the next day. That is highly possible. I am not saying that it is impossible, but at the same time, you have to be logical, right? A lot of people like to just, try to hit it big and they'll drop 50%, 80%, or even their entire account on a trade. Now, let's say that trade does not execute the way you wanted it to, right? And it goes against you the following day. That's 50%, 20%, 80%, or your entire account even, just getting decimated, right? So it helps you discipline yourself as to, you know, as a way to just take the slow gains, the little profits. They go a long way instead of just trying to hit it big. It also gives your money a chance to work for you longer, right? What's the point of having $10,000 if it's not working for you, right? And the number one way of keeping your money and having it work for you longer is by protecting it, by protecting your money. Your money could only work for you if it is protected, if it's there for it to work for you. If you have $10,000 and then you could put that money to work. But let's say you're not practicing risk management, you're not protecting that $10,000. it easily becomes $5,000. Right now, you have less of that money to work for you, which could, lead to a bunch of other things that we're not really going to get into. Actually, we are going to get into it. Um, but let's move on to the next slide. So there is different ways of practicing risk management. A few that we will go into today is having a cash account. Um, I feel like personally that's something that a lot of people do not, dive into, and a lot of traders do not know themselves because a lot of new traders, they start off with Robinhood. Um, that a lot of new traders go straight towards that. And the thing with Robinhood is that they do not offer cash account, which I think that's something that they should really introduce in the future as they improve their platform is having a cash account. They only have margin accounts, but of course, there's other brokers out there a lot of other brokers out there that, you could open a cash account with instead of a margin account, which is one of the most popular accounts that, a lot of traders are familiar with, especially the new ones. So we'll definitely go into cash accounts. Money management, of course, different ways of managing your money in terms of either playing options or just, straight up buying stocks for long terms. We'll also go into option spreads. There's different ways, for our option traders out there. This is very important. And also, this video will mostly cater to option trading as that is a majority of those are the type of trading that we do mostly in market rush trading and that we focus on. We also do a few stock trading as well, but option trading is is where we focus the most. So we will go over a few spreads that you guys can use in terms of money management to limit your risk. And also, number four, pretty simple, take breaks. You don't necessarily have to trade every day. Some people feel the need to do so, but like I said before in the introduction, it is a marathon, not a race. So you might as well pace yourself. You'll have days where you'll probably be making thousands of dollars, even hundreds. You could accumulate that slowly. It adds up at the end of the day. It's not, like I said, it's not a get rich overnight type of game here. And I feel like the quicker that a lot of traders understand that, the better it will be for them and their account and their growth process throughout their trading career. So let's move on to the next slide. So going into cash accounts. In a cash account, all transactions must be made with the available cash in the account. You are unable to borrow money from your broker to purchase securities, unlike a margin. So we will get a little bit into that, but simply with margin, you are also borrowing money from your broker. It is, you may use the broker's money or you may not, but it is there for you to utilize as well. But the thing with the cash account is that it is 100% your money. So if you have $10,000 in there, that's your $10,000. You don't have more or less to work with. You have that $10,000 to work with, right? But we'll get into the specifics a little bit more in the next few slides. So the benefits of having cash accounts, right, is settlement period. You'll come to see how that is, positive. It's also a negative in a way, but since we are making this video and we're talking about risk management in this video, settlement periods is going to be a benefit for cash accounts. And and another big benefit is the no PDT rule. So a lot of you guys, may be already familiar with the PDT rules. Only restricting accounts that are under $25,000. They are only limited to 3-day trades within the week. We will also go into that. And then another benefit of the cash account is having no margin. And let's move on to the disadvantages. The disadvantages is the settlement period and having no margin. And we will get into the specific of those into the next few slides. So settlement period. So with a cash account, there will be a settlement period on the money that you use to purchase a security, right? That security may be a stock, maybe options, bonds, whichever it is that you are trading. Once that security is sold, the money used will take about 1 to 2 days before it can be used again. So, of course, depending on the type of broker that you have, some brokers, their settlement period is 1 day, and others do have 2 days. So, within that example, let's say that you purchased, let's say you bought 1 share of Apple, actually 5 shares of Apple, right? You bought 5 shares of Apple on Monday. It's Monday. You bought 5 shares of Apple. Apple went up by $5. Since you have 5 shares, you're making a $25 profit. So let's say you sell that position within the same day. So you bought the position on Monday, and you're also selling it on that very same Monday after you gain $25 profit, right? So the money that you put in, the money that you use, once you do sell that security, once you're out of that position, that money is not available right away for you to trade with again, right? So let's look at the example below. So let's say you have a account that is $1,000, right? You have $1,000 in a cash account, right? And then, like I said, same example, you purchase, you use $300 out of that $1,000 to purchase a security. Like I said, it may be stocks, maybe an option position, whichever it is, it may be. So you use $300 to purchase a security. So out of that $1,000, you use 300. So right away, you only have 700 left to trade with to enter, any other trade, because $300 is already in this trade right here that you executed, right? So that very same trade, you sold that position for a $200 profit. That's more than 75% return. Those are great returns right there, and you decide to close that position and you take the profit. At that point, your $300 position becomes a $5. It becomes $5 in terms of $500 in terms of equity. So you are removing $500 in total from that trade, right? So with the settlement period, it will take 1 to 2 days for that money to be available for use again. So at this point, right? At this point, with the total, including the profits from that trade, right? Since you did put 300 in and you took $500 out of the trade, that account is now at, what is it? $1,200, right? It was a $200 profit. Your account is not at $1,200, right? Because you got $200 profit from that trade. So out of that $1,200, you only still have $700 left to use for the day. That $500 which you removed from the trade in terms of your initial equity and plus the $200 profit, $500, that $500 you remove from the trade won't be available for you to use that very same day once you take profit. You will have to wait 1 to 2 days for that money to be cleared before you could use it again, right? So at that point, you are left with $700 to possibly enter, different position or, different positions for the day. So it's Monday, right? It's Monday. So for that Monday, you have $700 left that you can use out of the $1,200 that, that your account is now currently on with the, $200 profit, of course. defense, the account started at 1,000. So I hope this is clear to you guys, and hopefully you're seeing how this helps in terms of risk management, right? So with a margin account, usually when you place a trade like this, that money is made available to you right away. Of course, that is the broker letting you use uh, their money as your money settles, right? But within this scenario, you have a cash account. So that money has to wait 1 to 2 days to settle before you could use it again. In terms of risk management, that's great because it prevents you from taking that profit, right? Let's say that $200 profit and putting it back in the market and risking it again. It helps you realize your gains and it lets you hold on to your gains longer than you would normally if you had a margin account, to where you'll probably take that $500 and just put it right back into the market, where you will be risking losing that $500, right? So let's not stick around on this slide too long. We do have some more. Let's move on to the no PDT rule, right? So right now we're going over the benefits of of we're going over the benefits and the disadvantages, like I stated with the cash account, right? So going back to the next slide, the benefit here, with the settlement period, is the fact that your money gained, your profit gained, you are it your profit gained, the settlement period within a cash account is basically forcing your hand in terms of not putting it back into the market, right? You just made $200, right? Most people, most traders, a lot of traders will just think that, okay, I could put that $500 in and make even more money, right? And boom, you are putting that money at risk. You are putting that money at risk of, you're putting it at risk of losing it. You just made $500. I'm not $500. You just made $200 profit. A lot of people within a day do not get that opportunity, right? And greed has a lot to do with this, and it clouds our judgment and shows, and it clouds our judgment to where we're not realizing that $200 is a lot to make in just one day. And most people, usually when they have a margin account, they just take that money and just put it right back into the market, to possibly lose it, right? And at that point, if you do not have a cash account and you have a margin account, and which they'll allow you to put it right back into the market before it sells, you'll most likely lose possibly the profit that you made, if not the entire $500 that you put in, right? And right now, and that basically will put you back to square one, or it'll put you 5 steps behind from where you started the day. So that's the benefit. So that's the benefit and disadvantage of having a cash account. The benefit is that, it lets you realize your profit longer. It doesn't allow you to put that money back in the market to risk, to putting it at risk of losing it. And the disadvantage is the fact that, it's not available to you. The money's not available to you right away. But in terms of risk management, that's good because, like I said, it lets you realize and keep that money safe. It doesn't give you access to it right away up until the following day or 2 days from that current day. So moving on to the next slide, right, with the no PDT rule. The PDT rule is very common for all traders. In its simplest form, the PDT rule only allows you to execute 3-day trades a week if your margin account is below $25,000. Remember that a day trade is the purchase and also the selling of the security within the same day. Let's say you open up a position on Monday, right, in Apple, and then that very same day, that very same Monday, you sell that position at a profit or at a loss, whichever it may be. that counts as one day trade, and you are only allowed to do that 3 times a week with an account that is under $25,000. A lot of traders, and a lot of beginners also, most beginners, don't necessarily have $25,000 to, put it into an account in order to do unlimited day trades. Usually they have to start, pretty low at 5,000, 100, not 100. I mean, $100. You can start with $100. Let's say $100, $1,000, 5,000. Those are usually around the borders where people usually start open up a brokerage account with. You don't necessarily have access to $25,000 for you to have unlimited day trade. So usually cash account makes it a little bit easier for you to, manage that small amount of money by giving you unlimited day trade. So as long as, within a cash account, as long as you have settled cash available, you could do unlimited day trades as long as you have that cash available, as opposed to a margin account where, you could have unlimited day trades, but you need an account that is at $25,000 at least, or above. So, that's another benefit too of the cash account, like I stated before, is that you get unlimited day trade. But as long as you have settled cash available, that's the downside to it, right? As opposed to the margin, you get unlimited day trade as long as your account is above 25,000. But then again, like I'm going to keep stating this throughout the video, it is a marathon, not a race, right? It is a marathon, not a race. So use the no PDT rule, towards a cash account. Very beneficial, extremely beneficial. And I hope you guys are realizing, how important it is to start off with a cash account, or to use a cash account to manage your risk, to protect your money, and to help you stay disciplined. So no margin, right? Like I stated, a cash account does not have any margin, right? And basically, just go over margin again. Margin is borrowed money from your broker. In reality, all brokerage accounts have settlement periods on the purchase and selling of securities. Having a margin account helps bypass that rule. So all brokerage accounts, um, all brokerage accounts have a settlement period, right? Regardless, but having a margin account helps bypass that. That's the difference. That's one of the biggest difference between a cash account and a margin account, is that the margin, since you are borrowing money from the broker itself, right? You have that money available to you right away. But whatever unsettled money you don't that whatever money that is currently settled, that you've used throughout the day, is being settled up until the next day or 2 days from you using it. It's just that with a margin account, you won't realize it, because at the end of the day, like I stated, you are using borrowed money. So even though you have, money being settled, uh, the the margin that was made available to you by your broker could be used, instantly, instead of waiting 1 to 2 days for that money to be settled, right? So instead of having to wait until your money settles, your broker will lend you the money so you can keep trading while your actual money settles, right? So with the cash account, 100% of the money is yours, 100% of it, right? So if you were to lose it, it is your money that you're losing, not the broker's money. If you were to gain from it, it's your gain. So that's the difference. That's one of the big difference right there. Because in a margin account, that is your money and the broker's money, right? If you use all your available cash and it is waiting to be settled, you will have access to use a certain percentage of the margin made available. to you. So another thing about margin accounts that is very risky is that uh let's say you utilize 100% of your actual money within a margin account, correct? Um, and at that point, your broker is, so depending on your broker, they will give you access to a certain percentage of margin that they made available to you, right? So you could actually use, you could actually use that, let's say that percentage, to open new positions as, while 100% of your money is waiting to be settled. At that point, you are working with borrowed money, which could be very dangerous if you do not know what you are doing in terms of entering a certain trade. Because at that point, not only you are putting the broker's money at risk, the money that they lend you in order to initiate that trade, you are putting it at risk. And at that point, if you are down, let's say you are down on that position with margin money, right? At a certain level, once that money depletes at a certain level, your broker will demand that you pay, that you cover that money. So at that point, what will they what they will make you do or warn you of is to deposit more money into the account. So at that point, you are adding more money just to settle that margin call that they initiated on your account. So that's more money that you have to put into the account itself, right? So I hope by now you're seeing the risk of having a margin account as opposed to having a cash account, to where 100% of the money on the cash account is yours. You do not have access to margin, which is a good thing, right? For most beginners, for most traders, that is a good thing in terms of risk management. Because at that point, not having a margin account, denies you that access from borrowing money from your broker, which could get very tricky and detrimental to your finances if it goes the wrong way. So moving on to to the next to the next slide. So ways of using there's many ways of using a cash account in terms of money management, right? You could break it down to where you use a certain percentage of that account to trade with every day. And that way you get to trade every single day. You get to day trade every single day. And that's a good way of, building up your account slowly, right? And because you do have the unlimited day trade, you could, put a certain money aside from your overall account to trade with every day. So looking at the table example above, well, not above, but on the screen, right? So let's say you have a $10,000 cash account, right? And let's say you would like to trade every day. So what you could do in terms of risk management for the entirety of that cash account is put aside 1 to 3%, right? 1 to 3% of that money for you to trade with. And I am speaking in terms of options trading, right? Since it is very risky, you could have a certain amount to where a certain amount within that account you only where you will only use that money for option trading, right? So as the example shown on the screen right here, let's say you allocate 1%. Actually, let's just do 2%. Let's say you allocate 2% every day and dedicate that 2% of the overall $10,000 cash account. Let's say that you put away 2% just for option trading, right? So on Monday, of course, 2%, you're only using $200 for option trading. Depending on our particular setup or the particular trade, you could more than double that money, that $200 on a particular trade on that Monday, right? And then the next day you do the same. And the next day you do the same. The next day you do the same. And let's say each day you double that money. So by the end of the week, you would have only used $1,000, right? About 2%. Well, not about, but 2% of the overall $10,000 account to double your money, right? At the end of the day, this $1,000 that you use, well, not the end of the day, but at the end of the week, the $1,000 you use becomes 2,000, right? And now your account is at 11,000, at the end of the week, because, like I stated with the example, with this $200 a day, you double it, right? You double it, and you keep doing that. By the end of the week, you'll have a extra $1,000. Your overall account will be up 1,000. By the end of the month, it'll be up 4,000, right? It'll be up 4,000, and by the end of the year, right? For um for 4,000 by times 12. By the end of the year, you'll be up, what is it? 48,000. You'll be up 48,000. So to a lot of people, well, I don't know about you, but 48,000 for the year, that is a lot to me, right? And a lot of people may not think so, but that's a lot. And that's all through just using 2% of your account. Just 2%, right? 2% on a daily basis, $200 out of that $10,000, right? 2% every day. And your goal is to double that money every day. You're only risking $1,000 out of that $10,000 on a weekly basis, you know, and that is to make 48,000 by the end of the year. So at that point, your account is at what, 58,000 for the year. That is well over 300% gain, right? You just beat the S&P. You just beat the S&P in terms of returns right here on a yearly basis. So, and that's just goes to show you that, by practicing risk management and by having access to a cash account instead of a margin, you're able to do a little bit more with less. Since the PDT rule doesn't apply to you, with a cash account, as long as you have, the settled funds, you could enter and exit a position at will, as long as you have the settled, the settled money. Yeah, that gives you the luxury of not having to swing trades to where, let's say with a margin account, you have no more day trades left and you're unable to close a profitable position. And at that point, you have to swing it for the next day. And we know how volatile the market's been lately. You could be up today and then entirely based on a news or even Trump's tweet or a tweet that Trump put out could send that entire position into oblivion to where you wake up the next day, you're down on it, right? So having a cash account gives you that luxury of not having to swing. It gives you the luxury of being able to get in, make your daily goal, and get out. And then you do it the next day, and then the next day, the next week, the next month. And just like I gave you with the example of, 2%, 2% a day, 2% a day, uh, $1,000 a week, right? In terms of your risk, and you basically double that. And by the end of the year, that's $48,000. So management. So on this slide, this is just basic, simple money management, not in terms of, in terms of both a cash and even margin account, right? So managing your money keeps you from blowing your account on risky trades. So having a certain percentage of so using a certain percentage of your account going into trade will keep you from risking and blowing your account, right? It helps you, like I said, it helps you discipline yourself for continued growth, and it gives your money a chance to work for you longer. Just just to stay, just to repeat that again, so it could stick with you guys, right? So this chart right here, you guys could save it, take a picture of it. It's very useful in terms of how much money, how much percentage of your account, depending on your account size, you should be using to go into a certain position or certain trades with, right? So, for an example, having a $10,000 account, right, risking, let's say, the maximum of $500. $500 is more than enough, for a trade, especially within options. $500 is way it's a little bit too much, but that's like a perfect amount to go into an option trade with. Just using 5% of that on a $10,000 account, right? That's great risk management right there. You are not, if you were to lose that $500, right? That's just how you should be looking at it. If you were to lose that $500, how far back will it set you, right? If you lose it, your account will now be at 9,500. Not too far. It's a step back. It is a step back from where you were originally, but still, it is not too far from where you started to where you know, you could work your way back in a short period of time to make that $500 back or even more, as opposed to you risking, let's say, $5,000 or even $2,000 out of that $10,000 account to get into a trade. Now, what if you lose that money? At that point, you are very far from where you initially started. Now you're down to $8,000 if you were to put $2,000 in out of that into a trade out of that $10,000 account. And let's say you keep doing that, right? Let's say you keep doing that. You keep risking 2,000, right? You lost it on the first trade. You lost another 2,000 in the second trade. And you lost another 2,000 in the third trade. You're already down $6,000, and now you just took a $10,000 account to simply 4,000. Now you have less to work with, and it becomes a little bit harder for you in terms of risk management at that point, right? Because you've already lost so much money. So this table right here, although looking at the $1,000 account size, even I know the allocation in terms of risk management, the amount of money that you could use for trading is very low. But if you're trading options, $50 is way more than enough, right? It's way more than enough if you are trading the right stocks, right? With $1,000 account, you should not be trading the Amazon options. You should not be dabbling into those. It's more of the Space, Neo, those type of stocks. Those are the ones you should be trading. Not the big boys, not the volatile stocks such as the Amazon, the Teslas, what else? The Shopify's, the Googles. Those are very risky stocks to trade options with. So get your money management right. $1,000 account, it's doable. Me personally, I've grown a $50 account to 700, right? In a matter of 2 weeks, just by, I mean, of course I did take a lot of risk, but that just goes to show you, right, that $50 is more than enough. So moving on to the next slide. Diversification is a very, very important and it's a very important part in terms of, account management, right? That's a different segment, but within the same category. So never put all your eggs in one basket. This applies to everything in life, including your brokerage account. Diversification is the process of allocating capital in a way that will reduce your exposure to risk in a particular asset. Options itself is a very risky asset to trade. It's best that you do not use the entirety of your account to trade it, right? So just wanted to put the meaning of diversification in there for some people, just for those out there who do not necessarily know what diversification means. Not trying to come at you guys, putting that information out there. So of course we're gonna go to our example of having a $10,000 account, right? This is just a recommendation. It has worked for me in the past, and I definitely think it's a good system to have, especially if you are trading options. Like I said, options are very risky assets to trade, very extremely risky assets, right? So what I would recommend is to put a certain amount of your total account, a certain amount aside for just option trading, right? And the rest could go into stocks that you've done your due diligence on, that have a nice growth rate on a yearly basis, such as most of the tech stocks like Facebook, Apple, or even the SPY itself. You could put at least 75%, like I mentioned here on the example, at least 75% could go into long-term stocks. Those right there would be, a majority of your initial account uh, being in stocks, right? All those stocks will have days where it's up and down, but with stocks, as opposed to options, you own the shares. As opposed to options, you have those positions within an options contract. You own it for a specific period of time, right? It's not forever. There is an expiration date. So if you have at least 75% of your total account within stocks, to where it is pretty much secured, unless that company just goes to zero, it's pretty much secured to where, as if you were even down on that position, it will go back up, especially if you put it within the right growth stock, right? Think of it as your passive money. The money that is there, it's working, but it's not working as fast as it would if you were trading options. And for options, I would recommend at least 25% of that of your account, or in the example above, of that $10,000 account, 25% of it going into options. Options is very volatile, very risky. So you want to put as little as possible in there that you are comfortable losing in order to actively build your account. So the option, the money allocated, the 25% allocated towards option trading, right, will be your active income. That's what you're going to actively be trading with, right? In this example, 25% of 10,000, which is 2,500. So that 2,500, that's what you're going to be using within that $10,000 account in order for you to actively build that account up. And 2,500 is way more than enough, believe it or not, right? If you're doing your risk management, if you are setting up your trades, technically doing your research, reading up news, following the news on a certain company, right? And establishing the right setup, that 2,500, you could do a lot with it. It could more than triple that account within the span of 3 months. 3 months, right? Within the span of 3 months. So that's a way, that's a little technique that you guys could use in terms of your account size, in order to diversify your account to where you're not using the entirety of your money in risky assets such as options, right? Because overall you want to build up that portfolio. You want to build that portfolio. All right, moving on to the next slide. So, one of the best methods in risk management in terms of options out there, for my option traders, is option spread, right? So most of you guys should be familiar with option spread already. If not, a link will be tagged under this video, or probably around here or so. because we did do a video on that. You guys go check that out and learn all about the different type of spreads that you could use, to uh limit your exposure to certain option positions, right? So option spreads, right? Playing spreads such as the call debit spread and the put debit spread are one of the best ways to manage your risk when playing options. It allows you to enter a position at a discount that would normally be too expensive for your overall account. Of course, we're going to take our $5,000 account example for this, right? So you have a $5,000 account and you are bullish on Netflix, right? Uh, you're very bullish on Netflix. You think it's gonna go through the roof, right? And you just decide to outright play a naked call. So a naked call is just simply you being one-sided, saying that this stock is going to go up, right? You are not protected in that particular position because it is a naked call. You are outright bullish on it. So that Netflix contract, right? The $500 call per se for next week, since this recording is being done on October 16th. So Netflix $500 call for the 23rd of October. That premium is $900 for you to enter that position in order for you to purchase this particular contract. At this point, with the example above of a $5,000 account, you are risking $900, right? Which is roughly 18% of that account to enter this position. So, as you may already know, a naked call gives you, maximum profit, right? So if Netflix does go towards, it shoots to the moon past 500, past 520, all the way to 580 per se, you are making bank. You are making money. And, you could share some of that with me, but you are making money, right? But at the same time, you are risking about 18% of your account, right? Almost $1,000 to the point where if you are if you are practicing risk management, you should not be risking this much, especially not in an options contract, especially not Netflix, and especially not within the overall condition of the market nowadays with election coming up, extremely volatile. The market is very sensitive to news, right? You should not be risking this. You could easily wake up, the next morning or even that very particular day. Let's say Trump once again sends out a tweet. God forbid something about stimulus, the stimulus package, or possible even more tension rising, with China trade war, the China and the U.S. trade war. God forbid a tweet like that or a news like that drops, and the whole market just falls and follows that news, that negative news. You could be losing almost everything. Almost everything. That entire $900 in that $5,000 account is probably at 400. I mean, not 4,000. 4,000. Let's say 4,500, $4,300, and you just lost basically more than 10% of that account from that drop, and that's just from the exposure of being in a naked call within that particular contract, which is Netflix, very volatile contract, right? As opposed to if you are playing a spread, right? The counterpart in terms of a safe risk management is playing the call debit spread. You are still outright bullish on the stock itself. You think it's going to go to the moon, right? You play that same position, but you're playing a call debit spread where you purchase, right? You purchase the $500 call. You purchase the $500 call while selling the 510 calls for the same expiration date, which is October 23rd, right? Now, in this scenario, since it is a call debit spread, it is limiting your exposure. It is limiting the amount of money that you put in. because you are getting the difference between these two contracts right here, the one that you're buying and the one that you are selling. Once again, if you're not familiar with this type of position, the link will be available probably around this area here for you guys. You definitely check out the videos on that for you to get familiarized, to familiarize yourself with these types of spreads. So like I said, the premium that you are paying will be the difference between these two contracts, right? Between you buying the $500 call while simultaneously selling the 510 call for the 23rd. So at this point, your premium becomes the difference of these two contracts, and your premium is $260. That is beautiful, because at that point, you are only risking 5% of that $5,000 account, to the point where, yeah, if it does go against you, which the possibility is always there, you will only be risking and you'll only possibly be losing 5% or $250, which is not a lot. It's not going to affect your overall account. It will, put you a little step back, but not 10 steps back, as opposed to risking up to 18% or $900 in this example over here to the left, right? You are only risking $250, 5% of that $5,000 account. And of course, oh wow, there is a typo here. This is supposed to be 260. It says 250. So don't mind the typo, guys, but you guys get the example. But also with call debit spreads, right, as opposed to naked call, your profit is maxed to the amount of the premium paid. So you could only lose the amount that you paid for that contract, but you are also capped to that very same premium. So you could only lose 260 in this example, and you could only make 260 also in this example. So it does limit your gains, but overall it limits your exposure, which is the most important part. The most important part in this example, because of course we are practicing risk management. So as opposed to risking 900, almost $1,000, you're only risking 260. It's not 250. We have a typo again, guys, because the premium is 260. You're only using 260 instead of $900. Which one of them would keep you at night, huh? Will keep you up at night? $900 or 250? I could go to sleep, knowing I only have 250 in a position like this, but a $900 position with a $5,000 account, I will be up for nights, until I close that position. I will be up. It will keep me up. I will not sleep. As opposed to 250, I'll think about it, but at the end of the day, I will go to bed, right? So option spreads, such as the call debit spread and the put debit spread, which is basically the opposite of the call debit spread. That's where you are bearish on the stock and you are expecting it to go down, right? To go to the grave. So these type of spreads are very good for risk management. They're perfect, right? Especially for small accounts also. It exposes you to as low risk of a risk as possible, as opposed to just playing a straight up naked call, right? So moving on to our next one. Oh, actually, this is our last one. Take a break. Take a break. A lot of traders, especially when you first get started, do not understand the meaning of taking a break. You do not have to trade every day. You do not have, I repeat, you do not have to trade every day. You could take a day off. You could take a week off, right? Enjoy your profits, right? Limit your exposure to the market. We will make money. We will make money, and only to give it back to the market, right? And now you're crying. Now you're crying. You can't sleep, and you're just wondering about a trade that you're probably thinking, "Oh my God, I shouldn't have taken it." But if you had taken a break, if you had taken a day off, even a few hours off, that money would still been there. You could take the break. Come back, the market will still be there. Trump will still be tweeting, right? Stimulus package will still not be getting passed. but, but yeah, it's still everything will still be there. Take a break. Trading could be very stressful, especially if you do it full time or part time. You don't necessarily have to be in the market every day. Every day that you are in the market is a day or more possibility and more ways of you trying to give your money, your hard earned money, back to the market. Why would you want to give your hard earned money to the market? If you want to do that, you might as well give it to me, right? Just give it to me. Because at this point, if you are trading every day, every second, every hour, every minute of the market being open, you are exposing yourself to a lot of risk because a lot of things could happen, especially in today's market, which is very volatile. It could be up 300 points, 500 points on the Dow in 1 hour, and literally in 30 minutes, we could easily lose that from just one person tweeting or one news dropping or one analyst, forecasting doomsday in the market. So take breaks, make a schedule for yourself. You could trade, 3 times out of the week. You could do it like we do at Market Rush Trading. We only trade 4 days out of the week, right? We keep the Friday. Friday is relaxed day, right? Heading into the weekend, you want to head into a smooth weekend, right? You don't want to give your total profit back to the market. You just take it easy. At the end of the day, it is a marathon, not a race. You will not get rich overnight, although it may happen, but do not expect it to happen. If you do, you are only setting up yourself. So guys, this is pretty much it in terms of risk management. I hope you guys learned a lot from this. Make sure to comment below or leave a like button if you like the content and it really helped you out. And I do hope that it helped a lot of you guys out also, because when I first started a couple of years ago trading, some of these things that I am telling you guys, I did not know myself, right? I did not know myself up until I did the research, but we're putting the content out here for you guys in order for you guys to, know exactly how to, be profitable, not only be profitable, but stay profitable within the market, especially how volatile everything's been this year with the coronavirus, the shutdown of the economy at the beginning of the year and the recovery. It is a very harsh market to trade in. So the more you practice risk management, the more you'll protect your money and the longer you'll stay in the game, Like I said before, I was going to keep saying this, it is a marathon, not a race. Thank you for watching and see you guys in the next one.
Thank you for watching. I hope you enjoyed and learned a lot from the video. Go ahead and smash that like and subscription button and follow us on social media for more content. And stay tuned for the next video.